Hello, good afternoon, everyone, and welcome. Thank you for joining today's webinar, Valuing Illiquid Assets. Today, we'll be discussing the regulatory expectations surrounding fair value measurements, the methodologies used to value illiquid investments, and some of the practical challenges that managers face when valuing level 3 assets in today's environment. My name is Anna Miller, and I'm the Strategic Growth Advisor here at Akram and Associates. I will be serving as your moderator today. But before we begin, I just have a few housekeeping items. Just switch to the next slide. Okay, so Akram is registered with NASBA. So for those of you attending specifically for CPE credit, you will need to remain connected for at least 50 minutes of today's session and answer at least 3 of the 4 polling questions that will appear throughout the presentation. If you have any questions during the webinar, please use the chat function in the upper right-hand corner, and we will reserve some time at the end to answer as many questions as we can. Following the webinar, everyone will receive a copy of today's deck. And for those of you that do qualify for CEP credit, your certificate and additional details will be emailed to you directly. If you go back one more quick. All right, just quickly, high level, just some of the program information. So the program level is basic. No prerequisites or preparation was required. And with that, let's go ahead and meet today's panel. Great. So I'm very fortunate to have this outstanding panel with me today, bringing together expertise across valuation, financial reporting, audit, and regulatory compliance. So joining us today, we have Dowd and Tom from Akram, Lynn Carrero from Kroll, and Daniel Sill from Houlihan Capital. And before I have the panelists introduce themselves and provide you a little bit more background on their expertise, I'd like to just briefly introduce Akram and Associates. So Akram provides specialized accounting, audit, tax, and advisory services. We work exclusively in the alternative investment space. We primarily work with funds, whether it's hedge funds, private equity, VC, digital assets, or real estate. We also work with some broker dealers, CTAs, and family offices. And because we work exclusively in this space, our team has very deep expertise in helping managers navigate this very complex landscape throughout the entire life cycle of a fund. And then joining me today, like I said, I've got Tom and Dowd. Tom, why don't I start with you since you're the first one here on my screen? Can you give the audience a little bit more information about your background and your role at Akram?
Sure. I'm an audit partner at Akram out of the Baltimore, Maryland office of our firm. I've been auditing most out my career of about 30 years, so you can tell I'm getting a little aged here. Most of it, over half, has probably been in the alternative investment industry with hedge funds, commodity pools, private equity, venture capital, through an old firm I worked for, Arthur Bell, which merged with Cohen Company, and I joined Akram about 1.5 years ago.
Great. Thanks, Tom. Dowd, can you introduce yourself, please?
Yeah. So I'm Dawood, Senior Manager at Akram, and by profession, I am a chartered accountant, and I have been in this audit space for the last more than 9 years. And at Akram, I am focused on audit and advisory services for alternative investment funds. A significant part of my work involves reviewing and challenges level 3 valuations under ASC 820 and ASC 946, particularly the methodologies, assumptions, and today I'll be sharing that point of view, that perspective from audit point of view. Thanks.
Wonderful. Thank you, Dowd. And then Lynn, you're next on my screen. Would you please introduce yourself and Kroll?
Sure, happy to. So I'm Lynn Carrero. I'm a managing director at Kroll. I work with the other MDs to oversee our U.S. compliance consulting team. We primarily work with alternative investment fund managers, but also have a full spectrum from wealth managers, 40 Act funds, business development companies. Kroll itself is a much larger organization. We like to think of ourselves as being a boutique within a much larger consulting firm that is focused on essentially two main areas, risk management and financial advisory.
Wonderful. Thank you, Lynn. And last but not least, Daniel, would you please introduce yourself and Houlihan Capital?
Of course. Thanks, Anna. And thanks, everyone, for tuning in. I'm Daniel Sill, a Senior Vice President in the Valuation Group at Houlihan Capital. So our valuation group is pretty industry agnostic, and we touch pretty much all valuation engagement types. A big focus for us is recurring portfolio valuations for our venture capital, private equity, and hedge fund clients. Another big focus is transaction opinions, supporting companies through acquisitions and on deals, purchase price allocations, and gifts and estate tax planning. I also lead the complex securities practice at the firm, so earnouts and embedded derivatives, anything that would need a Monte Carlo model, I'll be taking the charge on. So Houlihan Capital is not affiliated with Houlihan Lokey. We're a boutique firm of about 35 people, 18 on the valuation side, and then we have a lower middle market focused investment bank. Thanks.
Great. Thanks, Daniel. All right, so today's discussion is divided into two main sections. We'll first begin with the regulatory landscape surrounding fair value measurement, and then we'll transition into valuation practices, so specifically fair value hierarchy, the methodologies, and then end it with some best practices. So with that, let's go ahead and get started. Lynn, I'm going to turn this over to you. Can you walk us through the current regulatory landscape?
Absolutely. So can we go on to the perfect?
Yes.
Right. So looking at the main aspects of regulatory expectations, there's no specific SEC regulations or rules surrounding valuation for investment advisors. It's connected to your fiduciary obligation, and that requires you to act in the best interests of clients. And as a part of that, one of the requirements is that you're marking your portfolio asset at as close to fair market value as you can establish. The SEC also wants to see that you've adopted the right framework for the assets in which you're trading. So where you don't have readily observable values, have you really thought through how you're going to approach that? Are you ensuring that you have all of the necessary documentation that you need? So it's all going to tie back to your role as a fiduciary. But there's, several regulatory risks that can come your way if your valuation policies and procedures and controls are not in place. A couple of months ago, the SEC issued a risk alert on financial conflicts of interest. One of the biggest ones that results is that if you have incorrect valuations and your fee structure is based on your valuations, which for almost 100% of advisors it is in some manner, then you're going to end up in situations where you may have potentially overbilled clients, or we'll have to go back and correct stated valuations. So those are another issue. If your valuations are incorrect and people have subscribed or redeemed, there's real potential harm that can be caused to other investors there. So that's really where the SEC's focus and expectations are for managers, is that you will have the framework necessary based on the assets that you are overseeing to ensure that, your inattention or lack of controls around valuation doesn't result in actual investor harm. Can we go to the next slide, please? So what are some of the key considerations that the SEC is going to look for? So the first one is fairness and consistency. And this is going to come into play shortly when Daniel walks us through methodologies. But, the SEC doesn't want to see that you're changing up your methodologies or your approach to valuation without any real thought to it. So you want to make sure that your policies and procedures address your initial determination of which valuation methodology best works for that particular asset. But that you're also looking at when do we have to change that methodology, who gets to change it, how is that going to be approved and documented. It's the same thought process around making sure your policies and procedures draft in or address assumptions that you might be making in the process. If you're going to be using independent third parties to assist, where do they come in? Who has the ultimate approval over the established valuations? And then more importantly, all investment advisors are obligated annually to review their policies and procedures. I would say that, if you're valuing on a quarterly basis, you want to make sure that they're matching up to what you're doing. So if you do change the way that you're approaching something, make sure that you're keeping your policies and your procedures up to date, because having your compliance policies and procedures and controls not reflect the actual practices that you're undertaking can be extraordinarily problematic from an examination standpoint. And then we always get asked a lot about valuation committees and governance. I think it's important to note that the Investment Advisors Act requires you to take steps that are reasonable in light of your advisory operations. I view valuation committee in that same manner. So, if you have a large number of assets that require valuation, there's a fairly large number of constituencies who want to have input into that process or should have input into that process. And, we're going to be engaging in that because we've got level 3 on a quarterly basis or a monthly basis. Valuation committees would be almost expected under those circumstances. But we get asked a lot, what if we're only 3 or 4 people? In that case, the SEC is going to look at making sure you have your policies and procedures. What valuation discussions are you having? But the expectation may not be for a formal investment committee with agenda and minutes and all of that, but they will expect to see that there's defined approval or consideration of the valuations that are determined, as well as ensuring that there's some sign off or documentation around the process so that there is enough oversight. Next slide, please. There's been a couple of actually just this year regulatory actions around the valuation process that I think are very interesting insights into how the SEC is looking at these issues. And I think they also will tee up the rest of the presentation and the technical aspects that we're going to talk about against kind of where the SEC regulatory expectation sits. So in the first one in February, it was a settlement against Madison Capital Funding. Specifically, they were selling loans to private fund clients in a standard season and sell process. However, the SEC viewed that the steps that they took and the documentation that they maintained was deficient to ensure that those trades had been conducted at fair market value. the firm had represented that they undertook a full process, that the season and sell trades were being done under fair market value in the Form ADV and also in the fund documents and other representations. So when the SEC conducted the examination, they found that it hadn't been done on a consistent basis and that there hadn't really been enough independent look to justify saying that this was a fair market value. It resulted in a $900,000 penalty for the firm, or that was the settlement, and a cease and desist order. And then shortly thereafter in March, the SEC settled another action with Eisner Ampner. And this one is basically, when you go through, it talks about the obligation of auditors around the valuation process, and being able to rely on your audit teams. The SEC found that the audit firm didn't really grasp the internal controls that were around the valuation policy. And so they weren't really able to assess whether there were any material misstatements. They also failed to obtain sufficient documentation around the valuation testing and the fair valuation to ensure that it was actually in accordance with the auditing standards and the auditing plan. And at the end of the day, they felt that there was a failure to exercise due professional care or professional skepticism. And so I think those are all features that you should build into your process as well, in your policies and procedures, so that, you know, when your valuation auditors come in and they have to fulfill their obligations, you're able to provide them with all of the substantiating documentation they need in this area. I think it's also important to note, I'm sure you've all been watching the market. The SEC is paying a lot of attention to the private credit space at the moment. And so, you know, these are just kind of showing that just this year and earlier this year, we had valuation on the table as being a priority. So I think we can count on that continuing to be a key priority. And I think, you know, the SEC has been very public in their statements that they do have concerns around the sort of ballooning liquid, level 3 illiquid assets in the funds. So, you know, I think in terms of expectations, this is going to continue to be a hot ticket area. And actually, I think that's, I got maybe ahead of my slide. I think there's a couple of accounting evolutions, but bottom line, make sure you have the right policies and procedures and framework. So Anna, I'll turn it back to you.
Thank you so much. And the right service providers to support you in executing those. Before I move on to the first polling question, does anyone on the panel have anything else to add to what Lynn just covered? No? All right.
No.
Polling question number 1. Which of the following is a potential risk arising from inaccurate valuations in investment funds? A, increased liquidity for all investors. B, overpayment, underpayment by new investors entering the fund. Or C, guaranteed higher management fees. I'll give the audience just a few more seconds to submit their answers. All right.
A little pop quiz.
A little pop quiz. And the answer was B, so congratulations. All right. So, Tom, now let's continue having you walk us through the fair value hierarchy and how managers should think about distinguishing between those level 1, 2, and 3 investments. Oh, you're on mute.
What happens? I didn't want to disturb everybody else, so then you go
I
on mute.
know, it's okay.
I wanted
That's all
to,
right.
thank everybody for showing up on a Friday here in the summer. My mind's probably still where you see my background. That's Yellowstone. I was there last Friday. Kind of still wish I was there, but this is not a bad second place to be. All right, so we've thought between Dowd and I, we're going to give you a quick little either recap or an overview of what the fair value standards are from an accounting standpoint. The first thing is the standard ASC 20, which is the fair value measurement topic, provides that fair value is the price that we receive to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. So, what does that mean, and what are the concepts that are built into this? Well, first of all, fair value is an exit price. It's focused on what you would get if you sold an asset today, or what you'd have to pay to transfer a liability. It's not originally what you paid for it, so it's not an entry price, and it's not historical. It's about what the market would say right now and going forward. The second concept is, fair value is market based. It's not entity specific. So we don't ask, what does your organization think it's worth? I mean, I think we do indirectly, right? Because we want your valuation. But what we mean is, what would market participants that are knowledgeable, independent buyers and sellers think it's worth? It's their assumptions that should drive the measurement, not just your own. Because I know a lot of our investment managers are high on their investments and probably think it's worth, sometimes 10 times what it's worth. But we really want to know, what are other market participants looking at? The third item that goes into it is, what's its principal market, meaning the market with the highest activity for this asset or liability. If there isn't a clear market, then you look to the most advantageous market. So that's the one that would give the seller or the party transferring liability the best outcome. Now, what we're here really to talk about today is level 3. So, and a lot of the times there's not really another market. There are some instances, but how reliable is that information going to be when these are traded in a secondary market? And then the fourth item that we're looking at is its inputs. These inputs can be observable, like quoted market prices, or unobservable, like estimates when the market is limited. These types of inputs determine the fair value hierarchy that they're going to fall in. We can go to the next slide. Yep. I guess you moved on me. Go back one. Thank you. Sorry. All right. So now, what are these fair value hierarchies, right? Level 1, these are the easiest to do. These are the quoted prices in active markets for identical items. So this is, items on the New York Stock Exchange, NASDAQ, those types of securities. Level 2, there's observable inputs, but they're not level 1. So maybe you're using the stock price to value a warrant. Maybe it's an inactive market where you've got a security that's traded once a month, once a week. So it's traded, but it's just not real reliable. That might fall in level 2. And then what we're here to talk about today is unobservable inputs, often based on models or even judgment. So this is probably where we're going to focus today. We'll talk about some valuation practices shortly. But in summary, fair value, we said, is an exit price. It's grounded in market assumptions, measured in the right market, and supported by a hierarchy of inputs that must be clearly disclosed. Understanding these principles helps ensure, reliable reporting. And as Lynn brought up, making sure that you're meeting valuation policies that the SEC and others that might scrutinize it are going to look to positively. With that, I'm going to turn it to Dal to kind of go into a little deeper dive.
Yeah, thanks, Tom, for making out the base for fair value and the hierarchy. So as Tom said, level 1 is theoretically the simplest category in the hierarchy, but there are very important rules around when we can actually call something level 1. So ASC definition defines level 1 as the unadjusted quoted prices in the active markets. So in that definition, every word matters. The first one is quoted price. When we say quoted price, we mean a price for the exact security. We are not talking about a price for a comparable company, a similar bond, right? For example, if SpaceX shares are the asset being valued, the directly quoted price of that same Apple shares is not a relevant, concept. So second word in that definition is active market. The second requirement is that the quote, unadjusted quote, should be come from an active market. Tom defines that market as the market in which the transaction occur with sufficient frequency, like you can see on a daily basis, and volume to provide pricing information on ongoing basis, right? So the third thing in that is unadjusted, right? So why don't we adjust a level one price, and when we don't adjust a level one price? So there are some scenarios. The first one is blockage, right? Suppose a fund own 10 million shares, but a normal trading volume is only 1 million shares. Management may argue that if we try to sell all the 10 million shares tomorrow, we may push the price down. That's economically true, but ASC 820 does not permit a blockage discount for that reason, right? So it's not allowed. Second is holding or liquidating a strategy. Similarly, management might say that we are not going to sell the investment for the another 3 years, right? Or if we sold today, we would have to liquidate gradually. So that also does not change any level one price. Third is management believes that the price is wrong. Another situation is management believes that uh, the market has overreacted, right? The share closed at $40, but based on fundamentals, we think that it is worth 50. So for level one, it also does not work. Fourth thing in that scenario is transaction costs are also not deducted from the quoted price because these costs arise from executing the transactions rather than being characteristics of the security itself. So that's not allowed. Can you please move forward? So there are a couple of scenarios where we can say that we can adjust the quoted price, right? So there is one exception. I want to focus on that thing, that assume the fund owns a security that is trading in the overseas market, and the market closes at 4 p.m. local time, and the security, for example, closes at $100, right? Our fund, the NAV measurement time occurs several hours from the market close time. So between the market closing and our measurement time, there may be a major company announcement. You can say the company loses its major customer, announces a major acquisition. So the $100 quote was absolutely right when the market is closed. But the question under ASC 820 is, does that $100 price is still the fair value? So in that sense, ASC 820 permits us that the entity needs to adjust the closing price, right, for to account for that new information. But one thing which is very important here, that the fund who is carrying that security should document this thing and consistently apply that policy for identifying these type of significant events. Then at that moment, once we adjust these price based upon that new information, we are leaving the boundary line for level one. It's not level one anymore, right? Second scenario is that the active market becomes inactive, right? Like the trading in the security has deteriorated over time. Now we are seeing that very few recent transaction stale quotations who do not change frequently, and a significantly reduced volume over the period of time, and substantial variation among available prices. Then the question which arises is that, does this market is still active? So if the answer is no, then again we left the level one boundary and moves to level three or level two, depends upon the type of inputs we use. So one last thing based upon for this level one is the new, you can say, ASU gap has introduced, which is the ASU 202203, and that is very tricky. It says that if the restriction is contractual, like first of all it applies to publicly traded equity securities, and you should not be very you can say getting that equity security definition only associated to the common stock or the preferred stock. So in that case, you need to read that ASU, because this ASU has a very specific definition about the equity securities, and it does cover options and warrants. So you need to account for that. So I'm just quickly go through this thing through a litmus test, that if the restriction is contractual and specific to the holder, right? The holder means the one who is carrying that security. So that restriction is considered a characteristics of the reporting entity or the holder, rather than a characteristic of a security itself. So that is why we do not reduce the fair value, because simply because our fund is contractually prohibited from selling the shares. That's what ASC 820 is, which restrict you to not apply that DLOM, which is very common in our valuation practices. So, but one major, you can say, development into this thing is that on July 1, 2026, FASB has proposed a new ASU in counter to this SEU, which says that the private investment companies should be, reducing the fair value because of this restriction, because the economics was not right in the new SU. But as of this date in which we are giving and presenting this webinar, current gap is ASU 202203, and the proposed FASB ASU is still in concept and it's not implemented yet. So can we move to level 2? Yes. So level 2 simply sits between the level 1, right, and the level 3. ASC 820 define level 2 inputs as inputs other than level 1 quoted prices that are observable for the asset. The word observable is very important here, as Tom mentioned earlier. And typical level 2 evidences are follows. First one is that similar assets in active markets, where we do not have a level 1 quoted price for the exact asset, but we have quoted prices for the similar assets, right? Second thing is that identical assets in an inactive market. The second situation connects directly, as we discussed before, where we where the market becomes inactive and we have to left the territory for level 1. That's the same thing which we discussed in the previous slide. Third one is broker and pricing services costs. That's a very interesting thing. But another issue which arises from this point is that whenever we get a price from broker, we say that it's level 2. ASC does not allow you to trust this assumption. Management need to understand about the code and to determine whether the underlying information is actually observable. That's why I told you that the word observable is very important in the ASC 820 definition, right? And second thing about this broker code is that a binding or executable code may provide stronger evidence than a purely indicative code. So you need to be very careful that the code you are getting from the secondary market or the broker should not be indicative, like it should be executable and binding. So in that sense, it falls under level 2. Second, fourth, you can say level 2 input is market corroborated inputs. We may not observe directly, but we can derive or validate them using observable market data, right? One important thing for level 2 is about the models. So whenever we hear and discuss the thing about models, we think of it as jumping to level 3, like in the fair value hierarchy. So this is not true, right? Because if the significant inputs used by that model are observable or market corroborated, the resulting measurement can still be level 2, right? So the question is not that which model did you use. The question is that are significant inputs that drove the valuation are observable. So it needs and it falls under level 2 bracket. An example is, I believe, clear. We can accurately relate to this example now. Move to next slide. Yeah, so level 3 is where the valuation judgment becomes much more significant. ASC 820 defines level 3 inputs as simply unobservable inputs, right? But there is one misconception here, and which I believe we should avoid. Fund managers should avoid that. That level 3 does not mean that the management is free to determine whether value it believes is appropriate, right? The fair value objective does not change between level 1, 2, and 3. We are still trying to determine the exit price, which Tom has well narrated as per the ASC 840 definition. We can summarize the fair value as the exit price that market participants would use at the measurement date, right? So typically we have some level 3 inputs include cash flow forecast. You can see required rate of return, discount rates. Important thing is not memorizing this list. The question we should always ask is that can market participants uh, directly observe this assumption, or are we having to develop it ourselves, because relevant market information does not exist. And this is what drives the hierarchy. So this is the most important area that required evaluation discipline, right, for an auditor point of view. And the first one is that management assumptions are only the starting point. It cannot remain purely management specific. And for example, if management is using a 25% revenue growth as their forecast, the biggest question is that would a market participant use 25% based upon the information available at the measurement date, right? So if the market participant, you can say, indicates 15%, so we cannot ignore that evidence, right? We need to give the priority to the market evidence, as we earlier discussed that market participants exit price should be based upon market participants. Second discipline, you can say, level 3 does not mean that observable information can be ignored now. This is another common misunderstanding, is that level 3 investment, so observable market data does not really matter. Even instead, ASC 820 specifically requires us to maximize the use of relevant observable inputs and minimize the use of unobservable inputs while deriving the model in level 3. So and for example, you should be considering comparable transactions, financing rounds, secondary trades, public market movements, industry multiples, in your model preferably. Third thing is the calibration and reconciliation matter. That's an interesting one. Suppose you purchased an investment 6 months ago at $10 million, right? Today your model, your assumptions say that it's 15 million. So this does not mean, I'm not saying that 15 million is wrong, but you should be capable of making a bridge between 10 million and 15 million, and you should be asking questions as auditors, that was it revenue growth, or was it expected a change in expected timing, exit timing, or a change in comparable company multiples, a reduction in required return, a new financing now, what is that? So there are a list of questions which should be arising in your mind. And calibration, as per ASC 820, forces us to connect the valuation model with actual transactions evidence, right? So this is the important one. Fourth is assumptions need to be moved for a reason, right? That's another area which we've seen in abundance in our audit practices while we are reviewing the valuation models, that we should not simply roll forward the assumptions. Last year discount rate, last year multiples, or same probability weighting, same recovery percentage, and all those things. Uh, uh, each assumption should be reassessed at each measurement date. So it should be change. And secondly, you should also be asking from the management that if it increases the assumption with respect to last year significantly, so you need to also ask question that what evidence caused that change, and what is the reason behind that substantial change in assumption. The last one, you should understand and you should be completely reminded of this thing, that level 3 is not a permanent label. If an investment was level 3 last year, that does not mean that it is level 3 this year too. So you need to reassess this thing at each measurement date. There is an example that last year there was a private operating company, right, which then subsequently develops this year under a secondary market, you can say. Now you have the broker quotes, or maybe it becomes public, so you have the public traded securities. So it may vary from level 2 or level 1 at the next measurement dates. So that should be reminded of. I guess I am done.
Yes, Tom and Dowd, thank you so much for walking us through some of the fundamentals. So let's take a quick pause again and go to the next polling question. Under ASC 820, when do level 2 inputs generally become level 3 assets? A, when significant adjustments are made to the level 2 inputs. B, when they are derived from broker quotes. or C when they include observable market inputs such as yield? Is that cut off? That is cut off, right?
It is yield curve. Yeah, it's cut off.
Yield curve, that's what it is. Okay, thank you. That's why we couldn't see it. Take a few seconds and please submit your answer. All right, great. The answer is A. Nice job, everyone. But you can skip this one. Perfect. All right. So last but not least, Daniel, can you walk us through the various methodologies and the factors that influence which approach is appropriate for a level 3 asset?
Yeah, absolutely. Thanks, Anna, and thanks, Tom, Dawood, and Lynn for the overview. I think you all touched on points that are very relevant for the work that we'll step in to do. So level 3 investments are most often where you'd probably engage a third-party valuation specialist. That's when the complexity goes up, and having someone that's really focused in that area, I think, is really helpful for our clients. Valuations at this level 3 can sometimes be more art than science, and so there's a lot of assumptions that go into these models, but our goal at the end of the day is to support our clients in reaching the most sound and supportable fair value conclusions. So as far as valuing companies, you have 3 broad approaches. Probably in the hierarchy of reliability and preference would be the income approach first, then the market approach, and then the cost approach. Within the income approach, that's in that second row there, most often you'll have the discounted cash flow analysis. That relies on forecasted financials that are prepared by company management and can be fed through a model that ultimately tells you what the present value of the free cash flows to the firm are. Some of the inputs into that model is growth rate assumptions, profitability margin assumptions, as well as a discount rate. There's also a capitalization of earnings approach. This is one that you see slightly less commonly and probably not as applicable for fund managers, but for very mature companies, you can estimate the value of the company using a normalized level of profitability, as well as a discount rate assumption, a cap rate assumption. Probably more common for fund managers when looking at their investment valuations would be the market approach. So within the market approach, there's a comparable company analysis, also called a guideline public company analysis. That's going to look at public companies that are operating in a similar industry and have very similar operations to the subject company. What's great about this is we can see what market participants are pricing companies like this in a similar space. Most often what you'll do is take a financial metric of your subject company, something like revenue, EBITDA, and compare that to what multiples similar public companies have. What you have to do in this analysis is compare your subject company being valued and assess the size, growth, profitability, risk, and other diversification factors against these public companies in arriving at your selected multiple. Very similarly, you have the comparable transaction method. There's a couple other names, guideline transaction or M&A approach. This is similar in that you look at actual M&A transactions for companies that are in similar industry and operations. And again, look at the revenue multiples, EBITDA multiples implied from those transactions. This can be challenging. There's often not perfect comps, both in the public space and the M&A space. So a big consideration for us is really having a quality comp set. And to go back to the DCF, the reliability of a DCF really depends on a reliable forecast that was prepared thoughtfully by company management. Another broad approach is the cost approach. So this is really what it would cost to replace this asset or investment. This one's less commonly seen for fund managers, but it's useful for projects that are in process. Construction comes to mind for things that aren't fully built out, and the reliability of forecasted cash flows may not be very high. So those are kind of the broad and most common approaches. I think it might be worth touching on, kind of going beyond that. What we see for a lot of our fund clients is their investments are in very early stage companies. And so they might not be profitable companies and they might not even have revenues. As I'm sure many are aware or might agree with, forecasts for very early stage companies might not be the most reliable. And, there might be some very aggressive assumptions built in there. And so sometimes we don't have the ability to rely on these approaches just laid out, but that doesn't mean that those companies can't be valued. And so some maybe more niche approaches within the market approach is, looking at actual transactions in a company's stock. So that's kind of looking at a prior round, for example, Series A or Series B. Those are negotiated rounds from, knowledgeable investors, and, they negotiated with the company to come up with a price for the shares. So, if there's a recent transaction that we can look at, that's probably our best indication of value for a very early stage company. As time goes on, you might not be able to rely on that round, especially if the company hasn't had very much progress. And so you can use market approaches to calibrate from that round and come up with a value as of your current data value to adjust from there. I think Lynn had a really great point that consistency and methodology is a big consideration. And, for our clients, we're often on a quarterly basis, and really best practice is to stay on one methodology. If the quality of information is poor and, maybe you're not receiving regular updates, that could be a time to change methodologies. But in general, we'd expect to stay consistent quarter over quarter. So we can move on to the next slide. Yeah, so some considerations for those methodologies. I think I kind of laid them out already, but I think the biggest consideration for us is the reliability and quality of information. Again, if we don't have a forecast that we feel is reliable, maybe has some very aggressive growth assumptions or is projecting profitability very quickly, then we might not be able to rely on that approach. So having documented information definitely makes the evaluation process easier. I won't go line by line, but it's very much a matter of having discussions, with your third-party vendors like a valuation team and providing them as much information as possible. Because when the audit team comes in, it's, they're going to ask for that information and need to be able to look at actual audit evidence to support those valuation conclusions. So it's very much a team effort. And can move on to the next slide. Yeah, so valuing companies is, one step of this process. But again, for our fund clients, they need to go another step further. And you need to allocate the equity that you come up with for a company to the various share classes that are outstanding for the company. And part of that often involves accounting for the various rights and preferences that are due to these share classes. So this is a list of, the most common equity allocation methodologies. This is probably in order from most simple to most complex. The first one is the common stock equivalent method. That one's pretty simple. Let's say we value a company at $10 million equity value. You can treat all share classes as common effectively and divide by the number of shares outstanding to get to an allocated value per share of, let's say $1 per share. This approach is best for mature companies, ones that are probably imminently planning to IPO, or where the share classes have very similar economics. Some of the drawbacks here is you're, maybe aware that for common shares and preferred shares, there's a difference in rights and preferences. Preferred stock has a liquidation preference that ensures that they'll essentially get their investment value back before equity value gets allocated to other share classes. And so a common stock equivalent may not fully account for those protections that preferred shareholders have. Another approach is a current value method. And this is one that we see fund managers commonly using internally. It's allocating the value through a waterfall, giving that value to the liquidation preferences of preferred shareholders, the residual to common. This is more thorough, and it does account for some of the rights and preferences. Theoretically, it does ignore the time value and optionality that's attributable, especially to preferred shares. So again, this is probably most defensible when a sale or dissolution is imminent, potentially for a company that's very mature and close to an IPO. I'll skip PWORM for now and move to the option pricing model. For our work and for the work that we prepare for our fund clients, this is probably the most common equity allocation method. This treats each class as a call option and essentially incorporates the waterfall, but also accounts for time value and the optionality that's attributable to the various share classes. Now, this is a more complex model and there are more inputs involved. So there's an assumption on, the exit timing for a company, as well as the volatility that might be attributable to the company's equity. This option pricing model is essentially simulating a company's exit at a future date. So a lot of this involves, discussions with fund management on what expectations might be for, an exit, as well as with, the company itself if, we're communicating. This one is most preferred by auditors that we've worked with. This is probably the best method to account for the various rights and preferences, that are attributable to the shareholders. And I'll quickly go through the other ones. The PWORM and the hybrid method are pretty related, but a PWORM is a probability weighted expected return method. So, maybe a company is looking to IPO and that seems reasonably certain, but maybe there's a chance that it's going to stay private. And, as I walked through here, there's very different ways to allocate equity depending on what, the assumed, future exit's going to be. So you might have a common stock equivalent allocation for an IPO scenario, but you might use an OPM if you're expecting a company to stay private. You'll get to two values, and the probability, the PWORM method, you essentially apply what you are estimating the probability for each of those exit scenarios. And that gets blended into a blended equity value and share class value conclusion. So I think there might be one more slide here that I'll cover. Yeah, so best practices, I think I've tried to lay these out while talking through the approaches. Definitely compliance with the guidance is certainly important, what Tom and Dawood walked through. And as Lynn mentioned, staying up to date on regulatory updates. The FASB update in July is certainly something to consider. And the possibility of applying DLOMs to restricted equities or potentially crypto assets is something that you certainly want to be aware of. Again, I want to stress the quality of information as well as the availability of information. So much of what our work depends on the fund and our client being able to provide useful data for us to put into these models. So yeah, I'll stop here, and Tom, Lynn, and Dawood, if you have anything else to add there, feel free to jump in. But I think that covers it.
I think
Thanks,
I'm
Daniel.
good.
Yeah, I was actually just going to turn it over to, thank you so much. And Tom, to maybe just to kind of close out the overall discussion, perhaps sorry, never mind. I have a polling question. Last polling question, real quick, because we've got about 7 minutes left. All right. I got ahead of myself. When valuing an investment, which guideline emphasizes maximizing the use of observable market inputs, level 1 and level 2? Is it ASC 820, IFRS 13, cost approach framework, or proprietary pricing models? Just give you a few seconds here. The answer is A. Nice job, everyone. All right, now Tom. Tom, can you just briefly go through how third-party vendors can support some of these managers with the challenges that we just discussed.
Yeah, I'll go through this quickly. I do want to thank Lynn for earlier, mentioning, an accounting firm, an auditing firm who had scrutiny for not doing enough in ensuring that they did their work in testing fair value. So hopefully we have any clients, investment managers, you understand why sometimes we feel like we're being a pain, but we get as much scrutiny as the next person does. So what are some of these challenges that we all face from the valuations standpoint and from the auditor standpoint when looking at valuations? There's a lot of volatility between, measurement periods. Markets move quickly, sometimes unpredictably, and that creates real pressure on valuations. Assumptions that made sense a quarter ago may look completely different today, and there needs to be a constant, recalibration, which can be tough to manage. We're also looking at periods of inflation and rising costs, which affect everything from operating models to discount rates. It's not just, a background economic trend. It directly influences the inputs that are being relied upon and the confidence we can place in, forward-looking projections. Another challenge is aggressive forecasting. In certain sectors, we can see projections that stretch well beyond historical performance or observable market data. We know optimism's fine, but when, forecasts get far ahead of reality, it puts strain on the valuation process and increases, the level of challenge required by valuations specialists and auditors. On top of that, there's sometimes limitations in data. Sometimes information can come in late, could be incomplete. Sometimes markets simply don't provide enough transparency we need. So when that happens, we're forced to rely heavily on judgment, which increases the scrutiny that needs to be in place. And of course, there's, occasionally we can say there might be disagreements with auditors and independent evaluation firms. These usually stem from differences in interpretation, methodology, inputs, or market evidence. They're not unusual, but they do highlight how important it is to have clear and strong documentation and then open communication throughout the process. So given all this, and what we go through as auditors, we prefer to see firms work with third-party valuation specialists like Daniel at Houlihan. It's common in the landscape. They bring a level of independence that helps reduce the bias and strengthen objectivity. They also offer deeper expertise, not just in valuation theory, but in specific asset classes and industries, which is incredibly valuable when things get complex. These specialists, have experience with working with auditors. Daniel has mentioned he's worked with auditors, probably regulators, investors, and administrators, and that helps make the process more smooth and have less friction. They can support the valuation analysis and conclusions with robust methodologies, and importantly, they have team capacity to handle large volumes of work under tight deadlines where internal teams may struggle, during peak periods. And finally, I'll just say, they have access to market information and resources that many organizations simply don't have. That access helps valuations that are grounded in the best available data, especially when markets are moving fast. So, in today's environment, these capabilities aren't just helpful; they're essential. As valuation challenges continue to evolve, independent expertise and strong analytical resources, is one of the best ways to maintain credibility, consistency, and then confidence in the reported fair values. And with that, I think I'll stop because we probably only have a minute or so left.
We do, and one more question as well. So I'll go with this very quickly. Which of the following describes the general usage of third-party vendors in the business world? A, it is highly rare. B, it is very common. Or C, it is strictly forbidden. Give your obligatory 3 seconds to make your selection. And it is B. All right, and I don't see any questions that have come in on the poll. So I think with that,
I do
can
have
conclude.
one, Anna, one thing real
Yes.
quick. Tom's slide reminded me and something Daniel said. The SEC is not going to argue with you about whether your evaluations are correct or not. They're going to leave that up to the auditors. But what they will, to Tom's point, is they will look at how you got there. and determine if your methodology is sufficient. So, you know, on the slide, it talked about disagreements with auditors or valuation agents. This is very common. Where the SEC is going to be concerned is if you don't have that challenge process mapped into your controls. So I wanted to mention that real quick because I forgot. But then, you know, the second thing is when you are unsuspecting. So Dowd mentioned situations where something might be level 1 and becomes level 2 if we have trading halts. So we've seen a lot of firms who are trading totally liquid securities get caught out because they didn't know what to do when a trading halt came about. So I guess those were my last two pieces from a regulatory standpoint. Thank you.
Thank you so much, Lynn. Really appreciate your additional insights. And no, just a minute over time. So I just want to thank all of you, Tom, Mohammed, Lynn, Daniel, for joining today, and all of you that participated, all the audience members. Thank you for taking time out of your day. We hope you walked away with some valuable information. As I mentioned earlier, the presentation will be sent to you. And if you met the criteria, you will receive your CPE certificate over email from us. So with that, I hope you have a great rest of your afternoon, and we'll see you next time. Have a great weekend. Bye-bye.
Thanks, everyone.